In this episode, we're going to cover the top 3 things you should not do when it comes to investing. Hi, I'm Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. In this episode, we're going to cover the following 3 topics. So the first one is what not to do when it comes to investing, and it talks about investing when stock prices are high. So don't do that. We're going to cover that in the first topic. In the next topic, investing in non-dividend stocks. So that's another common mistake that people make when it comes to investing. And the third most common mistake here is investing in non-quality companies. So let's get started with our first investing mistake, which is investing when stock prices are high. So the lesson we're going to cover here is do not invest when stock prices are high. And you've all heard the phrase buy low and sell high. So why is that? Why do we want to do that? Why does it matter at what price you're investing in a stock or even in a mutual fund, in an index fund, or an ETF? Right? So stock prices go up and down all the time. Prices can be high sometimes and they can be low sometimes. So why is it important that we do not invest in stocks when the prices are very high? And so the reason for that is there's 2 reasons. One has to do with dividend income, and the second reason has to do with stock price appreciation. So we're going to talk about dividend income first, and then we'll take a look at the stock price appreciation. So the best way to explain the dividend income and the benefits of investing when the stock price is low is to go through an example with you right now in this episode. So in this example, we're going to assume that you have $10,000 to invest. Now you could start off with $500 or $1,000 or $5,000, but just to keep it simple, keep the math simple, let's say you have $10,000 to invest, and you're going to have 2 choices here. You're going to have the choice to invest in company A or in company B. And then, so let's take a look at the difference between company A and B and the implications of investing in one company over the other. So company A, you can see it up on the screen here. Let's assume the share price is $10 a share and the annual dividend is $1 per share. And now let's take a look at company B, where the share price is much higher. It's $50 a share, but the annual dividend is exactly the same. It's at $1 per share. So remember, a dividend is the company sharing its profits with you, the shareholder. So if you own, let's say 1,000 shares and the company is paying a dividend of $1, as long as you own those shares, the company is going to pay you $1,000 per year for as long as you own those shares and as long as the company continues to pay the dividend. So the dividend gets deposited directly into your trading account as cash. So you can spend that money if you wish, or you can reinvest it. So now back to our example here. Let's say you have $10,000 to invest and you have to decide between company A and company B. So let's say if you were to invest all of that money into company A, you're going to be able to buy 1,000 shares because the share price is $10. If you were to take all of that money instead and put it into company B, you're only going to be able to buy 200 shares. Why? Because the share price for company B is $50 each. So now again, you might be thinking to yourself, well, what's the difference here? Of course, I can buy more shares with company A. I'm going to be able to buy less with company B, but the shares are worth more. At the end of the day, you've invested $10,000 in company A or B. So the amount invested, the capital investment is the same in each of these companies. But now here's the difference. In company A, you will receive $1,000 a year for as long as you own those shares and as long as the company continues to pay the dividend of $1 per share. Now this is not dependent on the stock price because after you've made the purchase, you own those shares. So the stock price can go up, it can go down, doesn't matter. With company A, you will receive $1,000 a year in dividends. With company B, you're only going to receive $200 a year in dividends. Why? Because you were only able to buy 200 shares. The dividend is the same, it's $1 per share, but now you're only going to make $200 a year. So all things considered equal, would you rather earn $1,000 a year on your investment, or would you rather earn $200 a year on your investment? So you can clearly see that, again, all things considered equal, company A is going to be a better investment. And at the share price of $10, let's assume the price is historically low, it's undervalued, whereas the share price at $50 for company B is very high and it's overvalued, right? So the benefit here is because the stock price is low, you're able to purchase more shares. And remember, the dividend is paid not on the share price, but based on the number of shares that you own. So again, all things considered equal, company A is going to be a better investment. It's going to provide you with much more income per year than what you would make with company B. And like I said before, you can take that dividend income, spend it as you like, or you could reinvest it into other stocks that are paying dividends. And that's another way to grow your investment portfolio a lot faster. Now, let's take a look at the second reason. What is the benefit of buying low? And so the second reason has to do with stock price appreciation. Now, take a look at this, for example. With Google, this is their Alphabet is the name of the company. You can see on the graph in front of you, you can see that the stock price for the last, I guess we're looking at since 2014. So the last 10 years, you can see the stock price has gone up and down. However, without the dividend, take a look at this. The price was high towards the end of the year 2021 at around $150 a share. So had you purchased it back then, you would have had to have waited a little more than 2 years for the price to come back to where it was before, right? So the company has just started paying a dividend as of this recording. The first payment is going to be made in a couple of days. I believe it's June 17th is the first dividend payment ever. But prior to that, the company has not paid a dividend. So without the dividend, you're only hoping for the stock price to keep going up, right? So hope is not going to cover your living expenses, but the dividend income will. Now, here's the thing. When a company is paying a dividend and it's increasing the dividend over time, the stock price will come up. Why? Because every time there's a dividend increase, the dividend yield goes up, which means you can make more money. And a higher dividend yield is going to attract more investors to the stock itself. So you can make money, like I showed you before, through dividend income. And stock price appreciation is going to occur only, well, in your benefit if you were to buy the stock when it's priced low. So going back to our Google example, the Alphabet stock, there's no benefit in buying the stock when it's historically priced high, like I've shown you in the graph here. Because if you buy it at a high price, there's the likelihood of it going even higher is extremely low. And you can see it in this graph right here. In 2021, the stock hit a high of $150. 2 years later, it's just coming back to $150 again because the stock was purchased at a very high price. On the other hand, if the stock was purchased when it was low, for example, $50 a share, it was historically low, then when you buy it at a low price, there's a very high likelihood that the stock is going to go up because you're buying it when it's historically low. Now, to get more information on how to figure out when a stock is priced low, how to figure out when it's priced high, I really recommend that you go back and watch episode 1. We cover that in detail. And it's very easy to figure out when a stock is undervalued and when it's overvalued. So episode 1 is going to give you all of those details as well. So the lesson to learn here in our first topic is do not invest when the stock price is high. Now that also applies not only to individual stocks, but to mutual funds, index funds, and ETFs, because they hold individual stocks in those funds. So if you wouldn't buy a stock on your own that's priced high, why would you buy the same stock in a mutual fund or an index fund or an ETF? So that doesn't make sense at all, right? So as individual dividend stock investors, we can pick and choose and select stocks that are priced low. Now there's a couple of other things to check, and we're going to cover those in our next 2 topics in this episode. Okay, so let's move on to our topic number 2, which is the second most common mistake that investors make, and that's investing in non-dividend stocks. So the lesson to learn here is do not invest in non-dividend stocks, especially for beginners who are just starting to invest, especially if you're building your investment portfolio. You want to build a strong foundation. You want to have enough dividend income to cover your living expenses. It's very important that you stick with lesson number 2 as well. And so why? Why do we want to do that? Why do we not want to invest in non-dividend stocks? So here's an example. We're looking at a price chart going back to, I believe it's 1990 for Biogen. It's a pharmaceutical company, and this is a company that does not pay a dividend. And you can see, like I've said before, stock prices go up and down all the time. And for somebody who purchased the stock in 2015 at its peak, fast forward to 2024, as of this recording, you would have lost money. The stock is actually lower today than it was in 2015. And because there's no dividend, you would have earned $0 since 2015, since you've owned the stock. Because the stock doesn't pay a dividend, you have nothing to rely on except for the stock price. And all you can do is hope that the stock price is going to come back up again, or it's going to be higher when it comes time for you to sell the stock, because that's the only way to make money with non-dividend stocks, is eventually to sell them. And so here's the other benefit with dividend stocks is we don't eat into our capital. We don't have to sell our shares to earn more, because the dividend increases will help you to earn more. So a couple of things that I've already covered here, but dividends provide you with stable, consistent income. For example, Coca-Cola has been paying dividends since 1893. Dividends also provide you with growing income. Again, Coca-Cola, as an example, has had 61 years of consecutive dividend increases. That is 61 years of consecutive dividend increases. And every time the company increases its dividend, that's more money in your pocket. And then, of course, dividends provide price support to the stock price, because I've mentioned that before. Every time the company increases its dividend, the dividend yield goes up. That will attract more investors to the stock, and that helps to support the stock price. And we see that time and time again over the long term. As a company increases its dividend, the stock price starts to creep back up again. So let's take a look at 2 examples. We're going to look at Biogen and Amgen. Both are in the same industry. They're pharmaceutical companies. Biogen does not pay a dividend, so it's a non-dividend stock. Amgen pays a dividend. So we're going to take a look at both of these companies, and we're going to figure out which company is going to be would have been a better investment. We're going to go back to 2007. We're going to go back 15 years, and we're going to see which company would have been the better investment. So Biogen was founded in 1978. Like I said, it's a drug manufacturer, has 7,570 employees, has a market cap of $32.9 billion. It's an American company headquartered in Cambridge, Massachusetts. Amgen is also an American company headquartered in Thousand Oaks, California, founded around the same time, 2 years later in 1980, also a drug manufacturer. It is a bigger company, so you can see the number of employees is 26,700, and the market cap is $161.3 billion. So I know it is a bigger company, but they are direct competitors. And in this example, we are looking at the stock price performance over the last 15 years. And so that's what we're going to focus on to keep it simple. So let's take a look going back to 2007. You can see that Biogen, I've already mentioned before, does not pay a dividend. So you can see the annual dividend since 2007 is 0. And as of this recording, the company still does not pay a dividend. Amgen, on the other hand, you'll notice also back in 2007, did not pay a dividend. They only started paying a dividend in 2011. And the dividend at the time was 56 cents per share. The dividend today, as of this recording, is $9 per share. And that is an increase of over 1,507% in the dividend alone. So that is an extraordinary increase in the dividend in such a short period of time, since 2011. So Amgen has paid a dividend since 2011. So now let's take a look at the amount of dividends collected since 2007, right? So in this example, we're going to assume that you invested $10,000 in Biogen and in Amgen, so $10,000 each. That was the total amount invested in 2007. With Biogen, you can see, because it's a non-dividend stock, there is no dividends collected. However, take a look at Amgen. Since 2007, had you invested $10,000 in this company, you would have received over $22,000 in dividends alone, which is incredible. That is more than doubling your investment just from the dividends alone. So again, Amgen would have provided you since 2007 over $22,000 in dividends alone. So now let's take a look at the total return from each of these companies. So we're going to add stock price appreciation, and we're going to add all the dividends collected over the years. So Biogen, again in 2007, we start off with a $10,000 investment. Today, that investment would be worth over $30,000. And you can see the return is 205%. So that's pretty good. But is it better or worse than having put that same amount of money in Amgen, which is a dividend stock? So let's take a look. So in Amgen, we do the same thing. We invest $10,000 back in 2007. Today, including dividends, that investment would be worth over $120,000. That is a 636% return on your investment. And it gets better. Now we take a look at the dividend yield on cost, which is the dividend yield based on the purchase price. So I've already mentioned the dividend today is $9 a share for Amgen. And so if we take that and divide it by the share price back in 2007, you can see that this company would now yield 18% return on your $10,000 investment every single year. And if the dividend goes up again, that dividend yield on cost is going to go up as well. So 18% return on your initial investment is way better than any interest rate you can get in a term deposit or in a certificate deposit or in a bank account or even in a bond. So even though Amgen has gone up, has returned over 636% return, it continues to pay you, the dividend investor, 18% a year in dividends. So that is incredible. So you can see here a clear example that the dividend stock has not only outperformed the non-dividend stock, but it continues to provide double-digit returns year after year after year. So lesson number 2 is, just to repeat, do not invest in non-dividend stocks. Let's move on to our number 3, top 3 mistake that most people make, and that is investing in non-quality companies. So lesson here is, do not invest in non-quality companies. I call them lousy companies, right? They don't have quality, they're not quality stocks, so we want to avoid them. So what is a non-quality stock? Well, to illustrate this, I'm going to give you 3 comparison tests. We're going to go through the 3 of them one by one, and that'll help you to understand what is a quality stock and what is not a quality stock. So let's take a look at test number 1. We're going to take a look at company A and company B. You can see the share price is the same for both of them. The dividend is the same, $2 a share for both companies. Company A has a debt of 4%. Company B has a debt of 800%. Now, some of you might be thinking that's outrageous. That is a very big number. But there are companies today in the world that have debt of 800-900%. So all things considered equal, you can see right here that you want to avoid company B because the debt is way too high. And when the debt is too high, the company is going to have a hard time paying off its debt or paying off its creditors, especially if there is a market crash or a market downturn or interest rates go up. So if any of those things happen, company B is going to have a very hard time surviving a market downturn versus company A that is carrying very little to no debt at all. So you can see here, again, all things considered equal, company A is a quality company because it has very low debt. Let's move on to test number 2. Now we're going to look at company C. You can see the share price is $55. The earnings per share is $5 a share. So that's how much profit the company made. And out of that $5, the company paid $1 per share in dividends to the shareholders. The rest of the money the company kept for itself to reinvest in itself and to grow the business. So you can see the payout ratio is 20%. So 20% of what the company earned, they paid back to the shareholders in the form of a dividend. So the company made $5 a share and they paid $1 a share to the shareholders. Company D, you can see, has this share price is the same, earnings per share is the same, $5 a share, but the dividend is much higher. It is $7 a share. Now, some of you might look at that and decide, well, company D is a better investment because look at the dividend. It is way higher than the dividend that company C is paying us. However, let's take a look at the payout ratio, right? How could this company, and we're looking at company D, how can they pay $7 a share in dividends when they only earned $5 a share in earnings, right? They can't. They probably had to go out somewhere and borrow the money to pay the shareholders. So the payout ratio is 140%. So the company is paying way more in dividends than what it earned. So 2 things have to happen here. They either have to grow their earnings rapidly, or they have to reduce the dividend or cut the dividend completely. And as dividend investors, that's the last thing we want. We don't want the dividend to go away because that will cut down on our dividend income. So all things considered equal, company C is a higher quality company because their payout ratio is low. And they have room to increase the dividend the following year. Whereas company D can't do that. And they're more likely to cut the dividend, right? So the payout ratio is important. And the lower the payout ratio, the better it is for investors. Now let's take a look at our last comparison test, test number 3. We're going to look at company E and company F. What we're going to look at here is the last 15 years, I guess. We're going back to 2009. We're looking at the last 15 years of earnings history. So you can see on the screen, company E, the graph looks like this. It's a line just going down. So the company is making less money than the previous year, and then less money than the previous year. And we can see it's just going down, 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 down. Company F, on the other hand, is making more money every single year. And you can see the graph is going up. Now, there are no guarantees in life. We don't know what the future holds. We don't know if any of these companies are going to make money next year. We don't know if any of them are going to pay dividends next year. But just looking at these two graphs, we have a high degree of confidence in company F that it will continue to earn more in the future. The earnings will continue to go up, hopefully, because it has a solid track record of increasing its earnings. Company E, it's just the earnings are going down. So all things considered equal, company F is going to be a better investment. And remember, the more money the company makes, the more money they have to pay the dividend, and the more opportunity they have to increase the dividend year after year. So company F is more likely to not only pay a dividend, but also increase the dividend as well over time. So all things considered equal, company F is going to be a better quality company. So it's important to take a look at any company, to take a look at their track record. So what is a non-quality company? Like, what is a lousy company? It's going to be a company that fails these 10 rules that you see up on the screen here. We're going to cover these in just a couple of minutes, but you can see them up on the screen here. And we touched on some of them. For example, the debt, right? Is the debt 70% or less? That's good. Anything higher than that? Not so good. We talked about looking at earnings. So that's rule number 5. Is the company profitable? So that's important. We want to look at that as well. And then the payout ratio. Can the company afford to pay the dividend? Right? That's rule number 7. So when we're looking for quality companies, we want to make sure that they pass all of these 10 rules. So remember, lesson number 3 is do not invest in non-quality companies. And the same thing goes for mutual funds, index funds, and ETFs. If there's a company that you would not invest in individually because it's not a quality company, then why would you inadvertently invest in it when it's sitting inside of a mutual fund or an index fund or an ETF, right? Those funds own hundreds or thousands of companies sometimes, and not all of those companies are going to be priced low. Not all of those companies are going to be quality companies. So it's important to stay away from those and be able to select high quality companies when they're priced low. So then how should you invest? Our approach to investing is to invest in quality, dividend-paying stocks when they're priced low. And that's what we talked about in today's episode, is quality companies, so not just any company, and not just at any price, but when they are priced low. So how do you know when you're looking at any company anywhere in the world if it's a quality company, and how do you know if it's priced low? Well, for that, I've created what I call the 12 rules of simply investing. Rules number 1 to 10 are going to tell you if it's a quality company. And rule number 11 is going to tell you if the stock is priced low or if it's priced high. So you can see the rules up on the screen here. Rule number 1, do you understand how the company is making money? If not, skip it. Move on to something else. Remember, these 12 rules, this is your checklist. A company has to pass all of the 12 rules before you invest in it. So rule number 2, 20 years from now, will people still need its product and services? Rule number 3, does the company have a low-cost competitive advantage? Rule number 4, is it recession-proof? Rule number 5, is the company profitable? And we looked at this particular rule in today's episode, where we look at the last, we showed you an example of the last 15 years of earnings. We generally go back 20 years and we take a look at the track record of a company's earnings. So you want to make sure in rule number 5 that the company has a solid track record of profitability. Rule number 6, does it grow its dividend? Rule number 7, can it afford to pay the dividend? Rule number 8, is the debt less than 70%? Rule number 9, avoid any company with a recent dividend cut. Rule number 10, does it buy back its own shares? Rule number 11, is the stock priced low? So we look at 3 things: the PE ratio, the PB ratio, and then we look at the current yield and compare it to its 20-year average dividend yield. I cover that in episode 1 if you're interested to get more information on that. So if a company passes those 3 criteria, the PE, the PB, and the current yield comparison, then we determine that the stock is priced low and it's undervalued, and it passes rule number 11. And then rule number 12, keep your emotions out of investing. If you're interested, I've created a Simply Investing course. It's an online self-paced course. It's in 10 modules. In module 1, we cover the investing basics. Module 2, we cover the 12 rules of Simply Investing. Module 3, we apply the 12 rules. And module 4, you learn how to use the Simply Investing platform. Module 5, you learn how to place your first stock order step by step. Module 6, building and tracking your portfolio. Module 7, when to sell, which is just as important as to know when to buy. Module 8, reducing your fees and risk, especially when it comes to mutual funds, index funds, and ETFs. Module 9, your action plan for getting started right away. And Module 10, I answer your most frequently asked questions. We also have a Simply Investing platform that tracks over 6,000 stocks in the US and in Canada, and it applies the rules to all of those stocks every single day. So you can quickly figure out which stocks to avoid and which ones to consider. If you're interested, you may want to write down this coupon code, SAVE10, SAVE10. It's going to save you 10% off of the course or the platform as well. If you enjoyed today's episode, be sure to hit the subscribe button. We have a new episode out every week. Hit the like button as well. And for more information, take a look at our website, simplyinvesting.com. Thanks for watching.